Guys, Jamil, fantastic. All right, Mr. Cow, hey, fantastic. Go get him, guys. Konstantin, great. And Sam.
All right, thanks so much. So yeah, so you have two Sams on the panel, but no Sam Bankman-Fried, thankfully. And look, these guys are all, ex-TradFi. They came to crypto because crypto is exciting, and crypto really is the future of finance. And right now, we have Bitcoin at 67.8 thousand, according to the CoinDesk indices number. It's been a wild ride. We're in a bull market, but is this an efficient market? And that is our panel today. And so let's start with that. I mean, right now we have this big, huge crew of retail investors coming into the market. And Jamil, it's pretty expensive for retail folks to actually buy Bitcoin. Does that mean that it's not efficient right now?
Yeah, I mean, I think the cost to buy and sell is actually a great measure of efficiency. And let me throw out some numbers for you. And these numbers have actually come down just over the last 2 or 3 years. But today, if I'm a retail investor and I want to buy and sell $1,000 of Bitcoin, and I'm not going to name the exchange, but a very major exchange, and these are competitive prices, it will cost me about 50 basis points in spread and a couple dollars in commission. If I were to do that same trade in a U.S. stock, that same trade would cost me about 2 basis points.
Okay.
Now, with the advent of ETFs, that's brought down these costs quite a bit. So the average Bitcoin ETF in the U.S. over the last couple months, volume weighted,
all 6 people.
Has
name, title,
has a spread of about
in order
8 basis points. Yeah. So what does that all mean? Okay, what does that mean?
Not easy.
If I'm a retail investor and I want to buy $1,000 of Bitcoin and immediately sell it, if the price has not moved and I do that trade on a major exchange, it's going to cost me about $15 in spread and commission. If I do that in an ETF, it's going to cost me about $1.50. Okay. And if I do that in a U.S. equity, it's going to cost me about 40 cents.
Wow.
Okay. So $15 to 40 cents. Now that efficiency in U.S. equities.
This is the last one before lunch.
It happened
we'll try
over
to
a number
start
of years,
on time after.
And you're seeing that in Bitcoin.
We'll see how long these guys run. But
in the cryptocurrency
what's the lunch?
market. So is it efficient? No.
Just stand
it's
up
getting
buffet,
there.
Right?
As many people pointed out, it's still a nascent asset class, and so we're actually doing pretty well 15 years in.
Okay. Now, Konstantin, you were saying earlier that people don't actually care that much in the retail sector because you have FOMO, you have this excitement, you have an asset class that everyone wants to get into, and you were saying earlier that folks don't actually care that much about these costs. Is that true?
Partly, yes, and that would be quite contradictory. So my background is in TradFi, and I was quite lucky to spend like 10 years in the institutional side, and for the 5 years I was running one of the largest EM retail brokers on the equity side. And we did a few studies, which I think might be quite insightful for some of the retail exchanges or retail brokers, is when you ask directly a retail client to rank, like, what are the top 3 or the top 5 considerations when they choose the trading venue or a broker, they will definitely tell you that the cost, the spread, or the price or the fee they pay would be like the top 1 or the top 2 considerations for them. But on the contrary, we did a lot of the A/B testing when we actually changed the pricing for multiple client groups, and that had almost 0 impact on the amount they trade. So I'm not talking about like 0.5% of the fee versus like a BIP. That would definitely make a difference. But if we're talking about like 3 versus 5 or like 3 versus 10 bips, sometimes that is not the most important thing. And that would be quite contradictory, I think. But the question is, what is important? Yeah. And I think for the retail investors, it's the user experience that their broker can bring to them, which includes a lot of things, like the number of instruments they can get through their single mobile app. How entertaining is that? And going back to Robinhood, what they did is not only the execution free, no fee trading, but they did a lot of gamification. It's like the way you trade there, the way you buy there, they have some nice and shiny like gamification or like some visual effects, and that what actually helps to drive more volume. It attaches the retail client most, and that's what like we were seeing and observed on our retail base of around like 5 million users out there.
Is that a good thing though, right? Because do you really want this whole market gamified? Isn't that mean we'll have more shit coins and meme coins?
That's what I'll be extremely honest here. That's how most of the retail brokers are making their money. Because like if the client trades more, this is exactly what brings more volume. Is it good or bad? I mean, it's not us to judge here today,
sure, yeah.
But this is part of the game.
Okay, Jamil, any more thoughts on this?
Yeah, so a couple thoughts. I agree with everything Konstantin said. There's a disconnect between what retail investors say and what they actually do. Part of that disconnect is because they don't really understand. So they understand commissions, but they don't really understand spreads. And when you change the spreads, it's not necessarily transparent to them. But one of the things that I'm really optimistic about is we've seen in other asset classes, as the asset class becomes more efficient, volumes grow. So you saw three really big examples of that in the US, right? In the late 70s when fixed commissions were abolished, volumes just grew rapidly on exchanges. Then in the early 2000s when you went to decimalization, volumes again grew very, very dramatically. And then several years ago, when Schwab and the other online brokers got rid of their commissions based on what Robinhood was doing, then again you saw volumes just grow very, very dramatically. So right now we see huge volumes in Bitcoin. I think as the market becomes more efficient, those volumes are going to grow even more, and that's actually very exciting.
Okay, for sure. So we're at 67.8K Bitcoin. A month ago, it was half that, right? It's been a very exciting market. BitMEX, Sam. So what's next in the market, do you think? Do you think we'll have now 80K, 100K Bitcoin? Like, what is stopping us from getting to that point, do you think?
So I think we're heading north in the 3 to 6 month kind of time scale. What happens around the halving, we wait and see. For an exchange like ourselves, volatility is good. Volatility is based on what people's opinion of the market is right now. So we're seeing it higher in the medium to long term, but if we see a correction down towards 50, we wouldn't be totally surprised. ETF buying should put a floor on that, but short-term market activity may actually drive it a little bit lower.
Okay, that makes sense. James, what do you think? You're an old hat to the crypto world. Is this different, this market? Is it more efficient, less efficient?
Yeah, I think the ETF flows definitely does put a floor on the market. It's different from other cycles. We talked a little bit earlier about what drives retail behavior. A lot of it is driven through FUD and FOMO and social influences, driving sentiment, driving herd mentality to trade. And you can see typically the liquidity cycle when you have from the majors, it recycled into maybe layer 2s, into the meme coins. And that usually for other cycles may mean a local top. But I think this time might be different, right? As long as the ETF flows remain positive, I think that will continue to drive the markets upwards.
Okay, but at the same time, right, it's not great to rely just on ETF flows, do you think? Is there more to that than just ETF flows?
Yeah, I think you want to go? Yeah, I mean, there are more and more institutions coming into the space, and there are a variety of reasons. One of that, which is close to our heart at Bitstamp is regulations, right?
Yeah.
Do we want to get into that right now?
Sure, why not, yeah.
Yeah, so I think, we're always a big believer in having, balanced and fair regulations, right? Balanced and fair regulations promote, market stability, it protects the participants in the market, it reduces excessive risks. As long as they're fair, it tends to encourage and increase integrity and trust in the market. When you have that, institutions and retail will be more comfortable, the normies will be more comfortable in deploying their capital, and that will then generate more liquidity into the market. If you have the flip side of that, and you have too stringent of regulations, then it limits the participants and it will reduce the liquidity.
Well, I guess the key thing, though, is that normies are fantastic, retail is awesome, but the real money is regulated, right? Institutions and their massive pools of capital can't play in this market unless we have rules, right? Not strict rules, but smart rules and good rules. Neil, what do you think?
Yeah, I think we're at a really interesting time, right? So the intersection between the crypto native world and now institutions coming in, and I represent that institutional coming in. You know, we're backed by the Swiss Stock Exchange, SBI, who are big institutional players, right? They've been around for a very long time. When you talk about capital efficiency or efficiency in the markets, obviously the retail space, I think the price is very important, you know, the spread and commission. But the sophistication then on how do you really drive not just crypto, but the blockchain technology to create more efficiency into the market is really key. I think Prime, obviously, is one of the big areas. Also, we're sitting at this LTP conference. Cross-margining, I think, is going to be one of the biggest drivers of efficiency in the market. Being able to use collateral across multiple venues, across multiple types of product, that's what institutionals will drive. They want to see how can they don't want any capital at rest. I mean, I was speaking to a hedge fund the other day, and he's like, I can park my margin in US dollar, but I don't have a mandate to move money to cash, right? I need to have this working for me at all time. And one of the things that the new adoption you're getting from the major US buy side, like BlackRock, who have just announced, and obviously Fidelity have something going on, and Franklin Templeton, is they understand that, right? And they think, okay, how can we make sure yield is always available for people who want to trade crypto? So you're looking at the collateral market now with money market funds or tokenized treasuries really coming in. So you've got 5.4% on US treasuries, so you're getting great yield for anything at rest. And now a lot of institutional players have securities license. They understand that. They really know how to work that market. So this convergence between what you've got in the securities environment coming into crypto, I mean, you need the regulation in order to support that. I think the legal construct is going to be the biggest hurdle that crypto needs to clear there. But that really helps. So cross-margining, collateral, which is also always working for you, is going to be one of the critical pieces of creating efficiency in this market. Yeah.
Okay.
So I also want to make like a step back, and besides the ETF itself, what are the key drivers that are actually shifting the landscape because of the institutional demand? So what are the main factors that are driving the institutional demand and impacting the space? So I think we can identify three main factors. The first one is the alpha. So basically, the retail don't care that much, but institutions do care a lot because they need to compete. They need to compete for the client performance and for the client funds. And I'm talking both about the buy side and sell side. And the market is extremely inefficient. So whenever you can show to your clients that you can overperform your peers, that's when it becomes important. And that's what drives the market infrastructure changes and efficiency. So I think this is number one. The second thing is the regulation. And we already talked about that. I think we'll have more impact on the further fragmentation of flows due to the local regulation and the split of liquidity across multiple locally regulated exchanges. And not only exchanges, I'm also talking about the OTC providers and the OTC desks, the brokers. So regulation has a huge impact on the space. And thirdly, it is the efficiency of the market, the way how you can achieve more, I would say, like with the current fragmentation, how you can achieve more like performance for your clients, which also kind of intersects with the alpha. So I think these are the three main topics that will be driving the market space.
Okay, and one is definitely ramps. You know, a year ago, it looked like the biggest ramps in crypto were going to die pretty soon as the U.S. government went to war on crypto banks. But fast forward a year, and ramps still exist. I mean, we're at 67.8K Bitcoin. That means we have ramps to off-ramp to fiat. So I guess the question is, like, what do ramps look like these days, and how do ramps help the market make efficiency? Who wants this one?
Well, I mean, I'll have a stab. I think, you know, obviously the turmoil which happened in banking back in 2023 was difficult. I mean, and you still hear of people getting their accounts closed down in Singapore because they're a crypto organization. But as with regulation comes better governance, comes better risk mitigation, and banks get more comfortable with the business models of some of the newer venues, which allows for better flow, right? So allowing off-ramping into US dollar, particularly out of the US, is much, I mean, obviously there are participants in the US, it's become much easier. And you're seeing major banks now establishing themselves, such as like Standard Chartered, for example, who obviously not under the purview as much of the US regulator, but they're able to offer good services for crypto firms. They have a strategy around that. So I think ramping is going to be one of the big things that really allows capital to flow in and flow out of crypto. And then, but it still remains difficult for banks to really get into crypto because of Basel III restrictions, stuff like that.
Okay.
Yeah, I mean, if I could just add to that, the ramps have not been shut down, but they're still fairly limited. And I think until the large banks are able to get into that and provide many of the services that they do in traditional finance, it's going to limit the institutional adoption, and it's going to limit some of the efficiency gains, because one of the things that drives efficiency gains is scale.
Yeah.
The banks have massive scale across a number of different assets, and they're not going to be able to bring that to bear until, you know, from a regulatory standpoint, they can. And you know, some of the capital requirements that they have to offer crypto is really limiting. So until that gets addressed, I think the efficiency gains are going to be limited.
And I think we talk a lot about, you know, ramps, and a lot of it's centered around the US dollar, right? But if you look around the region, I mean, there's still, the banking relationships are available in each jurisdictions are still fairly limited, right? Until that is unlocked by clear regulations, we're going to see it very difficult for the domestic markets to on-ramp and add liquidity, the domestic liquidity into the crypto space.
But you guys are all ex-TradFi, right? So what is it, you think, in the minds of bankers that is a blocker to onboard crypto clients? Because KYC is now solved, right? Like, it's pretty intense, the process to get an account going with KYC. So what is it? Like, put your banker hat on and like think about like what's blocking them from onboarding more crypto clients.
I mean, I think there's two things. Number one is, and I'm going to talk about the U.S. for a second because that's what I know best, is in the U.S., the regulators have sent very, very clear signals to the banks that anything that they do in crypto is going to bring an enormous amount of attention. So number one, there's signals that the regulators have. So if you're doing anything, we're going to be auditing you, and we're going to be looking at, and no one likes that. Okay. The second thing is, you know, the SEC put out SAB 121, Staff Accounting Bulletin 121, which said that anything that they do in the crypto space for clients, they have to hold 100% capital reserves against those activities. So it's prohibitively expensive for them to provide crypto services. So those two things, how expensive it is from a capital perspective and the fact that it's going to bring enormous attention and scrutiny on all of their businesses, it's just not worth it. Someone earlier said, you know, it's all a cost benefit. So what revenues am I going to drive from it, and what are all the costs? Well, the costs are exceptionally high, and it's just not worth it. There's a handful of banks that are relatively small that, you know, they can do this because they get a huge amount of revenue, and you know, they can own the market.
So maybe one thing to add here about the institutional flows, and we should never underestimate the power of legacy, technology, and operations. So I've spent almost like 15 years in the traditional largest banking space, and if you've worked in a bank, you definitely understand how hard it is to implement a new thing, a new process. And right now, as an ECN, well, the largest ECN in the space, right now we onboard a few traditional brokers, a few traditional banks, and I can tell you that it takes them just 6 months to adjust the tick size, because the Bitcoin has like 8 decimals, and most of the TradFi systems on the EMS and AMS side, it just, for them to adjust the small change sometimes takes from like 6 months, maybe to 12 months. And this, you can imagine in a scale of things, this is this tiny part, and that what actually is delaying this massive crypto adoption. All of the committees internally that they need to go through to convince all of the internal like IT security guys, ops guys. So that will take some time. It doesn't mean that it's never happened. So it's always a question of when and not a question of if. And secondly, there is also a small component of perception. And if you read articles in the traditional media, crypto is still positioned as something not that institutional grade. So, and there is a saying like perception is reality. Yeah. So unless we, and actually it's our job here to change that perception, I think this is something that we need to closely work on.
But I mean, I think that's changing, right? I mean, the banks would love to get into crypto. I mean, from the people I speak to, and I speak to a lot of banks, they are, they're very keen. Because their clients, particularly in the wealth space, right? Their clients are pushing them. They're not getting that business, right? That business is going off to other crypto native venues, and they're like, well, I want this with all of my other assets, please. I want to see my crypto aligned next to my equities, my funds, etc. And they want to achieve that. I mean, I'm speaking to a major Swiss bank. If a client threatens to shut down their account because they can't do crypto, they will transact for them, right? So the pressure is there. And I think banks want to offer these services. It's really, I get then back to regulation. I mean, clarity from the SEC would be great, I guess, Jamil, but it's just, when's that going to come?
Well, Sam, you guys don't have ramps, and you're doing just fine.
We're doing okay. To have ramps would obviously be a lot nicer. I think for retail, the ramps are very important because you have to get in and out. Yeah. You trade your crypto, you make some money, it pays for your next meal out, your next holiday, whatever. For the institutional side, I think it's going to be slightly different. The ramps as they are expensive for single use, but that's bearable. I think for multi-use, we're not going to see anytime soon flipping between crypto and fiat as a sensible collateral management strategy. And this is where we go towards stable coins that are linked to treasuries. And there's obviously a few people around in the audience today who know a lot about that. I think we've seen some initial looks at doing that. Some of them are very pure match a treasury to a single coin. Some are a lot more like a money market fund embedded in a coin. That's going to be something I think the TradFi people will embrace. I don't think the retail people will care, but TradFi and brokers who are servicing retail in that way as well, that will be something that takes off.
Well, it's a tad ironic, though, that now the coolest thing in crypto is actually tokenized treasuries, which is like the de facto go-to asset for TradFi. It's kind of funny how we've gone full circle here.
It's almost like us TradFi guys were planted 5 years ago to make this happen.
Yes, the sleeper cells in crypto. Okay, so one more point about regulation. The US is the most powerful market in the world, but it's only one country. So what does this look like around the world, like in Hong Kong, Singapore? Like, how do they approach ramps?
Well, I think each country is
or the UK as well.
I mean, I can only speak for really the market that I know, and it's still difficult, right? I mean, I'm based in the Singapore space. It's still very difficult to do ramps in Singapore. You know, when you do the DD, it's a year's work, right, to get over the line with some of for US dollar, and that's not guaranteed. So you've got to look overseas sometimes. As more regulation comes in, I think it'll become easier, and more banks will do it. But that even then, the filter of it's crypto friendly rather than crypto easy, right? They are not trying to make this everybody can come in and, you know, they're saying, yeah, we understand. We'll look at your business model. If it works for us, then we'll adopt you. But the filter is quite tight, right? A lot of people don't get through. So there's a long way to go in Singapore, particularly for making access to fiat.
Okay. Oh,
Yeah, just maybe talking about the ramps. So we provide infrastructure for some of the on and off ramp payment companies globally from like 40 different countries. And what we see is there are a few local, like regional exchanges that started as exchanges with their own central limit order books. And some of them are like struggling with inviting the market makers to make the markets for these exchanges. So now they're finding the way of how can they pivot into something else that can bring value to the clients. And being a local on and off ramp is a great use to utilize their existing client base, infrastructure, and also the rails that they have built. So we see that some of the local players are actually becoming like a local on and off ramp providers, and I believe we'll see a major like market change and the market structure change. And even the biggest exchanges, I guess, you heard the news that recently are acquiring the EMI licenses. And that's what we will see. We'll see that happening on a smaller scale as well. So we'll have all the smaller players that will be providing and acting as a local on and off ramps. So yeah, it will be like the interesting change in the industry.
Like GSR just got a Singapore license, I think yesterday, and they're a market maker, they're not an exchange. Is this the future, do you think, for crypto? Like having market makers come in, get the license to access more capital from regulated sources, and will this make it more efficient in Asia?
Well, we are quite biased on that because we run as I mentioned, Finery Markets as an ECN, which is meant to serve market makers, and the regulated market maker is the future. So I believe with the market fragmentation we see in crypto, and by the way, crypto is the, I guess, most fragmented asset class in the human history. So the role of the market maker is one of the most important one in order to bring that efficiency into the space and like into the markets. So I see there will be more flow migrating from different venues directly to the market makers, and that will also be driving the market change. So yeah, I believe there will be more regulated OTC desks and the market makers that will start to do client-facing business, and yeah, we're happy to address their needs.
Sure. James, any thoughts?
Yeah, I mean, from Bitstamp's point of view, look, from day one, we've always believed that if you have the right regulations in place, which brings market trust and confidence, that will encourage more people to come into the market, right? So having regulated market makers can only help with that. I think if you look at, how the market has evolved, more and more, there seems to be a flight towards more regulated participants, whether it's exchanges or market makers. And I think as regulators become more and more comfortable with the market makers, I think they will see more and more of them getting regulated.
For sure.
And just to come back to what we said earlier, I think the regulation has to be right. If we have one regulated market maker, that's probably a disaster for the markets. We need to have, like in the FX markets, like 10, 20, 50 proper market participants to provide that liquidity. Otherwise, you have a monopoly, and that hurts.
I guess also then not centralized around one country as well, because you want this industry to be global and not all based in Singapore or in Hong Kong. It'd be great for these two jurisdictions, but you don't want, for market health, it to be all in these two places.
Yeah, 100%. If we could get towards something where people are looking at international regulation, I think it would be a huge thing.
For sure. So looking back at the last bull market, one of the hallmarks of that was the rise of the DEX. You had Uniswap and DEXs like that really make their mark on this market. And so, Sam, what do you think about DEXs? Are they efficient? Do they play an important role in the broader ecosystem, or do centralized exchanges do everything that DEXs can and they're better?
I think it depends on the product type we're talking about. So in spot, I think DEXs are climbing towards 10% of total volume traded, which is significant. It's a relatively easy way for inexperienced, maybe retail users to actually provide liquidity, probably easier than providing it through a centralized exchange if they're thinking about actively providing liquidity. Institutionally, everyone is used to providing liquidity through an exchange, so it's much easier for institutions to go through exchanges. When we look at derivatives, on the other hand, it's totally different. The cost for a DEX to run derivatives in terms of gas fees, in terms of the movement of the order book. So far, there's not a strong solution to it. So I think spot is there for now. If institutions can get their heads around DEXs, then it's a useful venue for them to use as well. But that has to happen before the institutional growth properly kicks off. Otherwise, DEXs, I think, will start to become a little bit of history.
Well, what's the blocker there, right? Like, what is stopping institutions from opening up MetaMask wallets and getting on board with those?
It's their own rules and regulations, right? So we have market makers who do provide exactly that service to bridge liquidity from DEXs to spot markets on exchanges and vice versa. But the idea of a Brevin Howard doing that actively, not sure.
So I just also give you like a practical use case. So if we're talking about like just using a MetaMask wallet, so the question is, who is going to keep the seed phrase? I mean, literally, who will be that person inside the bank who will like store it in a safe or like there's no procedure inside a bank that is meant to address that issue. And this is also one of the few issues which should not be underestimated if we're talking about the proper established regulated institutions. There's no clear regulation, there's no clear internal procedures. Will be there, but for now it's, and that's how all the innovations start, right? You need to have some first adopters, and then the big guys will follow, but we're still not there yet.
Any more thoughts? Anyone?
No, I just support that. I think it's really about governance, risk, mitigate. I think for institutional adoption into DEXs is a way off. The regulation isn't there to support it. Banks or large financial institutions just can't handle distributed ledgers right now for trading.
Okay, fair enough.
And just maybe one other thing to add from a risk department's point of view, how to get their head in a bank around protocol risk is going to be something totally new. I think that's 5 years away.
Yeah, how do you explain a rug pull to a boomer banker? Yeah, that's one thing. Okay, so like to wrap things up, like in the last year, what has changed from your guys' point of view in crypto? We've had Bitcoin on this wild ride. That's a big issue. But has there been changes behind the scenes? You know, things like seasonality, things like the type of traders on the market right now. Like, what's the big change, Jamil?
Well, I hate to point the obvious, but the biggest change has been the approval of the Bitcoin ETFs, because I think that what that's done is that's signaled to everyone out there that there's some institutional adoption, right? Larry Fink has been, on TV talking about Bitcoin, and that's energized the entire market. It's energized not only people who are directly buying that ETF, which is driving up demand, but it's also energizing people who are buying spot Bitcoin on exchanges directly. And it's energizing all the other coins, right? So it's not just Bitcoin volume that's gone way up in Bitcoin prices, but all of the others. And so I think that people are looking at that and they're saying, look, this is really becoming an asset class that's institutionalized. Many people are now saying, hey, there's an ETF, I should have part of my allocation in my retirement account in Bitcoin. And as more and more people think that, it's going to make that a more valuable asset class. And so I think that that's really what's driving a lot of this.
Okay. James, your thoughts?
I think just regionally, we saw last year Hong Kong regulators came out with the licensing regime for the exchanges. I mean, placing a lot of focus on growing Hong Kong as a significant market for crypto. I think that would drive the market not only just in Hong Kong, but it encourages other jurisdictions like Singapore to also kind of compete, right? I think what makes Hong Kong strong will also make Singapore strong as well, and the region. So I think with more and more, as regulators look at how each other have evolved their regulations, I think that can only provide further guidance into how we can move forward with regulations and therefore create a safer and more structured marketplace for everybody.
Okay, Neil?
Well, yeah, I think I really like your point there, James, about I think Asia is now becoming one of the the global leaders in, obviously US was historically the big leader and still is very, very, very systemically important to the crypto industry. But Asia really is now taking a foothold. I mean, you've seen that from the regulators. It's very clear. Was in Japan. They've been regulating since 2016. That market adoption is now quite stable, quite established. You've got Hong Kong, you've got Singapore. The other thing that just wanted to kind of affirm what you're saying, James, but the other thing which I'm really excited about is historically liquidity in digital securities hasn't been there, right? I mean, the Swiss Stock Exchange has been doing this for a while under SDX, and then the fixed income that they do is not liquid, right? I mean, it's some great stuff they're doing there with CBDCs and issuing fixed income. But now with major US buy side coming in, apologies to keep going back to this money market funds, but the realization for traditional finance of blockchain is starting to happen because it's being driven by the big US buy side. It's starting with money market funds. You're now seeing new adoption coming in as well. I think this is going to be huge. I mean, we're really at the dawn of that, but I think 2024 is going to be a really big story for digital securities as well.
For sure. Konstantin?
Yeah, so we observe one major trend from the market structure, and it's only one term which will drive the market structure. I think it's debundling. So that's exactly what we started to observe after the FTX, when suddenly people realized that it's not the best thing and not the best practice to have an exchange, a market maker, like a custodian and a broker, everything under the same place. So debundling, I think, really started after FTX, and that will be driving the market structure within the next years. And what I mean by that is a separation of market making from an exchange business. And there's still some players that do that, but they won't succeed in the long term. So that's one. The second thing is a separation of a custody function from an exchange, which I guess also a major trend for any venue that wants to serve institution. And so basically all the functions, and we're here at the LTP event, a prime broker. It's an extremely important function with the whole debundling, with providing the clearing and financing separately from all the other functions. So that's where we see the market will be going. And once again, we might be a little bit biased on that, as we also are part of this debundling execution-only process, but we'll see. It would be great to catch up here in a couple of years.
Okay, Sam, last words.
And yeah, just in terms of the institutional impact on the markets over the last 9 months, we've seen from a central exchange having 24/7, like totally active market, weekends have started to become weekends. If we look back in the last 9 months, the biggest Saturday, Sunday volume day was 30% of the biggest day. If we look back only to 12 months, 15 months, that was 75-80%. So weekends have suddenly stopped trading. I think that's must be driven by institutional activity, just people saying, okay, we turn things off on the weekend, we have a life.
So a work-life balance.
yeah. Unfortunately, running the exchange, it's still open, so I don't get that. But yeah.
Okay, well, that was great, guys. Thanks so much.
Thank you.
Thank you.
All right, great.